Good afternoon and welcome to the first Pearson Ham quarterly price index webinar. Today we'll be looking at how insurance prices have moved from the end of 2020 into the first quarter of this year. First, a little bit of background into who we are. At Pearson Ham, we help improve our clients' performance through pricing in several key areas. That can be from pricing strategy and capability development, governance and processes, through to implementation, including data and analytics and price optimization. As well as an internal focus, we have market price tracking services which provide a daily update on competitor movements, and that's what we'll be using today to look at how prices have moved. If you'd like some more information about our market price tracking insights, then please feel free to click on the link which is appearing in the chat at the moment and download our market insights guide. So we'll be looking at a bit of the methodology to begin with, and then we'll go straight into the insights, and at the end there will be a Q&A session. Please feel free, if you have any questions as we're going through, to log them in the chat, and I'll attempt to answer as many as I can when we get to that point. So the methodology that we'll be using is based on our panel of consumers who we have recruited, and they have given us permission for us to use their details to obtain insurance quotations. And we do that through the big four comparison websites in the UK. So this is for car insurance and for home insurance. We have a rotation of customers, so that there is always a day-on-day comparison. So there are always the same profiles being run on two subsequent days, so that we're able to get that day-on-day price movement. But there is a rotation, so everybody isn't running every day. And so at the end of the month, everybody has run, but there is a rotation that takes place. We also conduct some data cleansing and removal of outliers and any unusual price adjustments that we see. So we want to be really reflective of actual price changes within the market and report where prices have moved, rather than something that might be influenced by the way that the data is being collected or something else within that process. So we make sure that we are taking correct measures to be able to take out some of those unusual price movements. For our clients, we provide online reporting. So we have a Tableau portal which enables them to go in on a daily basis and look at how prices have moved on the previous day, along with some other useful key metrics. On a monthly basis, additional information allows a greater depth of analysis, and some scenario modeling is possible. So the sample sizes increase based on the the frequency of updates. So on a monthly basis, we have the full sample, which can be used for added analysis. Data is also provided to the clients so that they're able to conduct additional analysis themselves if that's something that they're interested in doing. Okay, so looking at price movements, so we'll be looking at private car and also some household movements which have happened this year. So just a quick recap on 2020. So what did we see happening there? So obviously there were a lot of things going on in 2020 as a result of the coronavirus pandemic. So we observed greater numbers of people working from home and taking traffic off the roads. So that obviously resulted in reduced mileage. So the types of mileage that people were expecting to drive in the year were greatly reduced. And obviously prices had been set based on expected mileages. So there was a significant margin implication for insurers there, where the frequency of claims was vastly reduced. So this resulted in some customer refunds. So Admiral most noticeably providing that £25 per policy refund to its customers, but also in price reductions. So as insurers realised the financial benefits of reduced claims frequency, they were able to invest that into some price cuts. We saw an increase in pay-as-you-drive propositions. So as customers became less confident about how much they would expect to drive in the year, then these types of propositions became more appealing to them. And we saw an uplift in demand for those, as well as an increase in those types of propositions on the market. And we've seen that over the past 6 months, quite a few new propositions have been launched. Because of what was going on, we also saw a significant change in the mix of business. So new drivers were out of the market because driving tests were no longer taking place. New vehicles were taken out of the market because dealerships were closed and people were unable to purchase new vehicles. And because of the move to working from home, the mix of drivers on the road was impacted by that. So there was an increase in the types of people who are unable to work from home. So the types of occupations which are kind of less able to work from home would have been more represented on the roads. Commuting also resulted in an increase in the number of less experienced drivers. So where people may have been previously taking public transport to work, that method of transport became less appealing because of the associated risks of the coronavirus, and resulted in more people, if they had to commute and were unable to work from home, choosing to use their own car to do that. So there was quite a lot of things going on and quite a lot of moving parts. So how did that manifest itself in terms of price movements? We also saw at the end of the year, in September, the FCA announced its proposed pricing remedies to tackle price walking and unfair pricing practices within general insurance. So in terms of price movements throughout 2020, at the beginning of the year, prices had started to come up. So there were some storms which had driven some price increases there, and following some reductions towards the end of 2019, the cycle looked as though it was on the up again. Obviously, we were hit by the pandemic in February, March, and we saw some kind of leveling off and dropping of prices there. So in March, the prices increased, and we did see some movements in response to the pandemic and the logistical challenges that insurers were facing in terms of getting call centres to work from home. So there was some reduction in quotability in terms of the number of quotes that insurers were returning to the market, and also prices increased to reduce the volume of calls and the volume of business until they were in a position to understand a bit better what was happening and to address some of those challenges around kind of ways of working and getting the call centres sorted out. As we moved into the third quarter of the year, competition intensified. So insurers were chasing the same volume, and the benefits of reduced claims frequency had become clearer, and investments were being made into price reductions. But it wasn't the investments weren't necessarily driving the levels of volume that were expected. So as I say, insurers were chasing the same volume at the same time. The market was shrinking. So we had seen kind of new drivers were not coming into the market, and record numbers of vehicles were being taken off the road as people were not driving them. So we were seeing a lot of that activity happening around that time. Competition continued to drive prices down into the last quarter of the year, at which point we saw a bit of a leveling off in December. But over the course of the whole 12 months, prices dropped by around 5% between January and December. Bearing in mind the prices had started to come up at the start of the year, so that 5% drop is really kind of based on the last 3 quarters. Okay, so what's happened so far this year? So we've seen a continued drop in prices. So that leveling off in December has now gone. And each month this year, we've seen relatively significant price cuts in the motor market. So far this year, the price cuts have been the equivalent of the whole of 2020. So we've seen another 5% drop in market prices during that first quarter of the year. Looking at it by segment, driver age, price cuts have been fairly evenly spread across all segments, so that there hasn't been necessarily a lot of targeting. What we do see is slightly smaller reductions for the youngest drivers, so for those under 26 and for the over 60s. However, there isn't really a significant difference between them. So where we're seeing those price reductions, they tend to be across the board. Looking at by region, so it's interesting to think about how the different lockdowns have been implemented in each of these separate regions, and what the different measures have been, and whether that's had an impact on the insurer's response to prices that are being returned. So what we see here is, again, there isn't a kind of a great deal of difference. The reductions are still being applied. It's not as though the reductions have been targeted to specific areas. So we are seeing larger reductions, in England and Wales than we are seeing in Scotland and Northern Ireland. Whether that is driven by insurers' anticipation of the different impacts of lockdowns in those different regions, I'm not sure, but that's what we're observing on our panel. So looking back over the past 12 months, so moving from April 2020 into March of this year, so we've seen prices dropping by almost 12%. So thinking about the methodology that we use, the price movements are based on a like-for-like comparison. So these are the same individuals, the same consumer profiles who are kind of being kind of targeted with price reductions month on month. So there is no impact of the mix change coming into it. So where some of our kind of other market indices will be using average prices quoted on comparison sites, then we can tend to see some impact of mix there. These are on a like-for-like basis. We've seen prices drop by almost 12% over the course of the past 12 months. What does it look like on home insurance? So home insurance is a relatively new product area for Pearson Ham, and we started tracking in November. So we have a couple of quarters of price movements. So we'll look at this year what's been happening first. So on combined buildings and contents cover, which is the largest part of the market, we've seen prices drop by about 1.4% since the start of the year. So those have been relatively consistent 0.5% drops each month, and that we've seen on combined cover. How have things moved since we started tracking? So from November, we've seen prices come down by about 2%. So we were seeing towards the end of the year, those price reductions were being observed, and those have continued and increased slightly into the new year. On contents only, we have seen some larger increases. So particularly in February and March, where prices have come down by 1.7% each month. So in total, prices have dropped by about 4%. So more in line with what we've seen on motor insurance, we are seeing on contents only. Again, looking at how things have moved since we started tracking. So it's interesting to note here that in November and December, actually prices were slightly up or flat. So it's really since the beginning of the year that we've started to see those reductions, and those reductions have been sharper than we've observed in combined cover. Okay, so looking at what might be driving some of the price movements that we're seeing, then the FCA is a good place to start looking. So we have seen an amended timetable for the implementation of the FCA pricing remedies. So we went through a consultation period which closed on the 25th of January. And during that period, the FCA received over 100 responses, and almost all firms came back to say it would not be possible for them to meet the deadline that had previously been proposed. And that was a 4-month deadline to implement the new rules from the announcement. So they kind of reviewed things and gone back because of the need for insurers to develop the kind of new testing and pricing models for recoding of IT systems to support the implementation of those models, and at the same time as having to deal with the effect of the coronavirus pandemic. So the new timings are, as we can see here, the policy statement will be published by the end of May, and any rules that it plans to implement will be announced and finalized then. There is then a period until September, which the implementation of systems and control rules and product governance rules will have to be implemented. So looking at those product governance frameworks and reporting and kind of the governance around responsibility for pricing within organizations, and then the actual pricing changes, so the pricing remedies around the renewal prices being no more than the equivalent new business prices. Insurers now have until the end of the year to implement those changes. So based on that, we expect to see further price fluctuations throughout this year and into next year. So I think there are some specific stages that we're looking at. So from now until September, I think we're going to see some jockeying for position by insurers, some kind of initial strategies, and there may be some kind of land grab strategies where insurers are investing into price reductions to drive more business ahead of the new rules being implemented. So while they still have their last opportunity to invest in lower prices, which can then be increased in line with the previous lifetime value models, then I think there's some of that going on. And I think when we're looking at what's happened so far this year, then I believe that those strategies, combined with the margin benefits of having a kind of an additional lockdown period at the beginning of the year, are playing out in terms of the price cuts that we're seeing. I think when we get to September and some of the initial pricing and price governance remedies are in place, and it's then a case of finalizing the actual price changes and implementing those, we may see some strategy refinements based on the current view of how the market's moving, because insurer pricing responses will be to some extent based on how their competitors are moving, how the overall market is moving. And then there will be the final adjustments ahead of go live. So I think what we can expect to see for the rest of this year is some further price reductions as insurers drive some of that additional business. We will see a deterioration in loss ratio as the benefits of the lockdown are kind of diminished, and as we kind of ease restrictions and gain some form of normality, hopefully towards June, then we should see kind of prices perhaps starting to level off, and by the time we get to October, I would expect those price increases to start to be implemented. So where there has to be a rebalancing between your renewal and new business prices, then I think ultimately that means prices at acquisition, so the prices that we are seeing and what we are kind of collecting on price comparison sites are going to start to increase, and I think that's probably going to be in the last quarter of this year, based on what we've observed so far. There are obviously going to be different strategies that insurers can adopt and will be adopting at this time, and there may be more targeted areas receiving price reductions and others receiving price increases, and we have to wait and see how that plays out. When we get to the end of the year and move into 2022, that's when we're going to start to see large variances between renewal prices and those prices that were paid in the previous year. So prices at renewal will be linked to the equivalent new business price rather than being linked to the previous year's price and capped and collared on that basis. So there is the potential for quite big kind of price movements to be seen by customers, and in our experience, we do see that impacts negatively on retention. It stimulates more shopping around, even in cases where the price movement is in the favor of the customer. So where prices are lower than they were last year, then again, that triggers shopping around activity as much as prices being higher than the previous year. So as we go through 2022, I think we would expect to see an increase in shopping around as those price variations are kind of being observed and experienced within the market. At the end of 2022, moving into 2023, that's the last phase. So where the new business prices in the previous year were aligned with the new regulations. So we'll have a full year of that. So renewal and new business prices will have been implemented within the new guidelines. So we would expect to see a bit more stability there. However, there could still be significant price movements between what was paid last year and what's being requested at renewal. If there are kind of changes in the risk profile, so if the risk profile has changed for a particular region or for a particular age band or whatever that driver is, then there may be those reductions which aren't limited by the current process where capping and collaring would be used to kind of dampen some of the movements that are being observed by customers. So there may still be some of that going on, which again could stimulate shopping around. So I would expect people who have learned over the course of the past 10 years to visit comparison sites and shop around will continue to do so. And those who are kind of more accepting of renewal prices should see a bit more stability and may settle down a bit. Okay, so I'll just have a look through any questions that may have been raised as we've gone through. And if you do have any questions, then do feel free to just log them in the chat as we speak. Okay, so the first we have here is, how do you see prices moving in the rest of the year? So I think I probably have covered that. So I think what I would expect is to see some acquisition strategies playing out, and also the benefit of reduced claims frequency in the first quarter of the year. So I think we can expect to see continued price reductions ahead of the implementation of the new FCA pricing remedies. So where that kind of the prices start to pick up, I'm not sure, but I think I would certainly expect prices to continue to reduce, maybe not to the same extent as they have in Q1. I would expect them to reduce again in Q2, and then towards the end of the year start to pick up, and then there may be some significant price increases being applied. So there's been a lot of talk of a hardening market following COVID. Do you think this will happen? I think there is a potential for that to happen, but there are other things happening, and kind of the biggest one obviously is the FCA change in regulation. So I think there is there will be a deterioration in loss ratio as restrictions are eased and more drivers return to the road. I think there is the potential for mixes to change and make some of the profile of people on the road higher risk than they may have previously been. So people with kind of less driving experience, who aren't used to doing that commute, who may be doing it now, may kind of sway the risk profile. So I think there are probably some good external factors that would suggest that is what should happen. But I think there are also competing factors around regulation, other regulatory changes, whiplash reform, which may kind of dampen things down a bit. So I don't think there's necessarily going to be a hardening of the market following the easing of restrictions. I think there will be, but it will probably happen closer to the or following the implementation of the FCA regulations. So what difference do you see in price movement in motor as compared to home? So we've been through the home movements at the start of the presentation. I think we were saying as we would expect the FCA regulations to have a bigger impact on home, which could suggest that we would expect to see those strategies exaggerated in home, but that's not quite what we're seeing at the moment. So in Q1, we've seen car prices come down to a greater extent than home, and I think a lot of that is driven by the kind of the benefits of lockdown. So where home doesn't necessarily have the same benefits there, I think the 0.5% reduction that we've seen each month, and within the quarter, is probably about right. And again, I think we would continue to see some of that as we kind of in the run up to the regulations being implemented. Do you expect any significant differences between the FCA impact on home prices and on motor prices, i.e. home market more impacted than motor? Yeah. So I guess that's the same answer. So I think I would expect home to be more impacted by the new regulations, and prices will behave in the same way. So I think we will see that reduction and then coming up again. Okay. All right. So thanks for the questions. There are a few more in there which I'll attempt to get back to you directly with answers to. If you'd like some more information about Pearson Ham, more generally on pricing, on insurance pricing, so this is not related to our market pricing, but more general insurance price consulting, then please feel free to download the guide that's now appearing in the chat. And thank you for your time. So please also feel free to contact me directly if you have any questions or would like any further information. And if you'd like to know a bit more about our pricing tools or how we can benefit your business at that time. What we are hearing from our clients is that there's a lot going on, and it's more important than ever to be able to understand how market prices are moving. So please join us again for the next quarterly Insights webinar, which will take place on the 7th of July. If there's anything that you feel should be included within this session that wasn't here today, then again, please let me know, and we'll see what we can do to accommodate those changes. Thanks very much.